My name is Daniel.dalmolin. I'm a financial advisor here with Global Financial Consultants in Singapore. And today I want to talk a little bit about tax and the implications of possible higher taxes in the future. Today's topic is a little bit about taxation. In my opinion, I feel that taxation is going in the next few years. How those changes in tax are going to affect us, affect all of us taxpayers, and what can we do about it? In the earlier chart that's just been flashed up, we can have a look and we can see that most governments around the world are spending far more money than they're receiving in tax. That means that in future years, that will have to be repaid. The only way they're going to be doing that is to raise taxes. So at the moment, the European Union, I think, is running a budget deficit of about 3.7%. The US is running a budget deficit of about 5.7%. Australia is running a balanced budget, first time since 2007, and the UK is running a deficit of 3.9%. Most economies are in fairly good shape, and at this stage of the economic cycle, things are doing okay. Usually governments should be balancing their budgets at this stage of the cycle, but they're not. So maybe some of the reasons are there's a lot of coalition and fractured governments, especially in Europe. In the US, we have examples of the Biden administration signing into law large infrastructure projects that will run deficits or at least increase government spending over the next 5 to 10 years. In Australia, there's still a lot of social spending since the COVID lockdowns. So this tells us a little bit that we will have high taxes for longer. So what's different today? Basically, that leaves us in a position where, regardless of in each country who's going to be the next government, is we will be paying the bill. That means that we will have to pay this expenditure that's going on at the moment, meaning most governments will raise taxes in the near to long-term future. What are the opportunities? Yes, it's a little bit of bad news, but there are opportunities. So where does it leave us? It leaves us in a situation where we need to have a look at areas. We are not proposing anybody should be avoiding taxes. I think we all should be paying what we legally are required to pay. But we should be trying to strategize and use the system to pay what we need to pay. And where we can, as offshore residents or offshore expatriates, shielding assets as much as possible from future taxes. Because today, most corporate tax rates are between 30 and 35%. We don't know. They might be higher in the future. Companies might be required to pay more tax. So have a think about what assets you've got today, those assets that you might need in 10 or 20 years' time, and if tax rates go up, how will they be affected? And can we use strategies to shield those assets from future taxes? So some ways in Singapore we can shield ourselves from higher taxes is using the tax system here to get some tax relief on some things we do. One of the main areas that I tell most clients is to open an SRS account, where we effectively don't pay any tax, or we get a tax relief on what contributions we make into an SRS account. The other thing is to buy local life insurance, where you can get some tax relief on this. For those PRs and citizens, certainly making or maximizing your CPF contributions, which give you tax reliefs. Educational expenses, there are some courses, etc., to better yourself here in Singapore that actually are paid by pre-tax dollars. And of course, donations is quite a good, generous tax relief if you want to donate money to regulated charities here in Singapore. Shielding ourselves for Australian expats here in Singapore, there's two very effective ways. One is that we can use the insurance bond while we're here in Singapore to contribute tax-paid dollars and let it sit overseas for 10 years plus. When we're back in Australia, when we retire, we need the funds. We can take those funds out without paying any capital gains or dividend income tax. The other way is to use this superannuation system where if we've got local income in Australia or rental income, you can use super as in concessional contributions to help relieve some of that tax obligation. If we look across to the US, if you own shares, direct shares, vested shares, ETFs, funds that are domiciled or in situ assets in the US, if something was to happen to you and these assets were to pass through a will or probate, they would attract up to 40% in US estate taxes. There are tax-free limits of about $60,000 US for Singapore residents and higher for Australian residents, but you'll still be attracting some tax. Although, if we use an insurance wrap, we can shield these assets from estate taxes in this case, if there's any unfortunate circumstances that happen to you, and these assets can be passed on to the next of kin. If you're a UK citizen working in Singapore, there's also strategies and areas that we can use to shield ourselves from a lot of the inheritance tax. So basically, this sort of tax planning is something that cannot be done last minute. You have to prepare yourselves and you have to think about situations that are going to happen next year, the year after, the year after that. When do you propose to go back to your home country, or where do you propose to retire to? All taken into the same calculation. An old friend of mine used to tell me that tax should be planned at least 3 to 5 years in advance. So please, if you have any questions, get in contact with us. A lot of these products that we're talking about are licensed products, so you have to buy them or invest in them through a licensed provider. Happy to help, happy to answer any questions. Thank you.